Everyone has to live somewhere, and everyone has to invest their money someplace. So what happens when where you live meets up with where your money is invested? Hello, real estate. Hey, welcome back to Big Money Real Estate. I'm Ilyce. So crowdfunding is all the rage these days, and while many startup CEOs still dream of landing a big investment from an angel investor like Shark Tank, right? The trend of amassing large sums of money from small investors on platforms like Kickstarter and a host of others that have been introduced recently continues to gather steam. But while this type of crowdfunding has helped launch some big new ideas, to date, it hasn't quite worked the same way as traditional investments. So investors in Kickstarter projects usually receive something in return for their money, but it isn't generally equity in a business. Might be a t-shirt, might be something else, but it isn't equity. For that to happen, the SEC needs to revise its regulation regarding private investing. And guess what? That's exactly what they did with the new Regulation A+ rules, which took effect in June. These new guidelines, which were written as a component of Title IV of the Jumpstart Our Business Startups, or JOBS Act, remember that, will allow businesses to raise up to $50 million from accredited and non-accredited investors alike, both sides, prior to filing for a true IPO. Now, to get a better idea of how this new brand of investment funding is supposed to work, I've asked Salvador Rodriguez to come on the show. He's the Silicon Valley correspondent for the International Business Times, and he's just written an article on the new Regulation A+ rules. Welcome to Big Money Real Estate, Salvador.
Hi, thank you for having me.
That is a very long introduction, but I wanted to give everybody at home some background, shall we say, on how this is actually working. From your point of view, where are you seeing the changes and what kind of an effect do you think they're going to have?
So I cover technology, so my focus has been on how this will affect tech funding. And already we've seen, like on Friday, I wrote a follow-up to my article where I did a quick roundup of 5 tech companies that are already starting to look at this and use a feature in these new rules called Test the Waters, which essentially lets them go out, talk to their users, talk to whoever, engage the interest that there would be in investing in their company, which is something that they haven't been able to do with other kinds of rules before. So this is pretty interesting. And the fact that there's already this many companies going out and looking at it is pretty promising for these new set of rules. But the entire investment community has told me that they're not entirely sure how this will play out. Some people don't think that there were enough changes to actually make an impact, but others think that for some companies, especially very consumer-facing companies with very loyal customers, might be able to take advantage of this and use it as a way to make their customers feel even more involved with what they're doing by letting them actually, like you said, take equity in their company. So it's still playing out, but it's off to a very hot start.
So accredited individual investors, who are the ones who are always supposed to be investing in hedge funds and other quote-unquote risky investments, they were supposed to have a net worth greater than $1 million or earn $200,000 a year for an individual or $300,000 as a couple. But the new capital market rules, this A+ rule, seems to allow more people to weigh in. Is that right?
Yeah. Before, under the rules that we've been playing prior to Friday, it was basically the top 2% of America were allowed to invest in companies that they had no, ties to before they went public, and that's obviously very restricted. Now it's open to essentially anyone who's got some money to spend. I believe you can spend up to 10% of your yearly income. And so that's opening up the playing fields to many more people. And I know from a couple of angel investors and venture capitalists that they're interested in seeing, what your average Joe, your mom and pop is going to do with this opportunity. Maybe they'll take advantage and put a couple $1,000s into one company. But the thing that they do have to remember if they do this is that, as one of my sources said, this is not a lotto ticket. Most companies don't end up going the way of Facebook and Google. So you should only invest what you can afford to lose.
And I want to just emphasize that, you know, investing what you can afford to lose. To me, this whole thing, what I've been able to read about it, it just allows people to opt in, you know, get in on these early stage tech investments in your case, for example, but this is also going on in the real estate world with a lot less information. It feels to me like people who are doing this investing may think that this is an automatic way to be a tech billionaire or a real estate millionaire, but it's extremely risky, isn't it?
Well, yeah, I mean, there is a good chance that you might lose money. There's a chance you might break even, or it might not be too much. But at least this time, though, uh, the people outside the top 2% of America are getting a shot at, really getting some huge returns, like the people who invested early on Facebook. Because, I mean, if you remember, by the time Facebook went public on the NASDAQ, they already had more than 1 billion users. So if you bought their stock, that's great. They're doing really hot since 2012, but you clearly did not get in on the ground floor. And at least under these new rules, there is a risk, but there's also a chance at getting those big returns finally. So that's pretty promising. And you mentioned that in the real estate market, there isn't as much information. Now, like I said, it's all still playing out. But one of the websites that I was looking at was called Start Engine, and that website looks at companies that are beginning to test the waters, and they have a whole page for each of these companies where potential would-be investors can go and read about it and learn before they decide to commit to investing in the company.
Well, learning more is really important. Now, the new A-plus rules that went into effect on June 19th, there's two tiers, I think. So the first tier allows up to $20 million to be raised under NASAA review with no state preemption. So investors will have to file in each state, but it's not subject to formal auditing and annual reporting. The second tier allows up to $50 million to be raised, but this requires the companies to do formal auditing and annual reporting, but there is a preemption for blue sky laws, so it removes the requirement to register the offering in each state. But then there's still financial audits and financial reports that have to be filed annually. How aware do you think are the companies who are raising this money that they have all of these reporting requirements? Do you see them actually doing this? And because it's kind of in reverse where they have to do all this reporting, but do they have to do it before they raise the money or sort of on an annualized basis? So it could be after they raise the money. What is your understanding of how people are supposed to get access to the better information?
Well, let's start with Tier 2. In Tier 2, they're going to have that first report, I believe, before they actually go public, just like you would if a company was filing for an actual initial public offering. So the potential investors would have to have access to that information before it actually gets going. And then after that, from my understanding of reading all the laws, is that these companies that do go with the Tier 2, which again is the $50 million option, they're going to have to be reporting these their finances on twice a year, essentially, right?
Semi-annual.
So it's kind of like an actual public company, but instead of having 2 quarters, you're going to have, 4 quarters, you're going to have 2 semesters. With the Tier 1 option, that's more restrictive, where they're going to have to, essentially file in every state where they want to be offered. And so in that scenario, one thing that some of my sources said might play out is we might see companies file more regionally. So in tech, you might get a lot of these mini IPOs, but they might be restricted to California, which of course is an area that is very familiar with tech startups and oftentimes gets access to startups before other parts of the country. The restrictions with Tier 2, with the reporting, that might actually deter some companies from going that route, simply because often, at least in the world of tech, as you guys have probably heard or read, revenue doesn't come until much later, right?
Right.
So in order to avoid having to report loss after loss after loss, some companies may choose to go with the 20 million option route instead.
I don't know. I still think that for people, just average people, and I know you have to have quite a bit of your income, you're basically already in the top 2% if you're going to be able to qualify for this. It just feels super risky to me. I guess we're going to have to see how it plays out. And the cost, just to be clear, for companies to do all of the filing is estimated to be between $25,000 and $100,000. I'm not sure if this is just tier 2 or it's both tiers. So the real benefits may elude small startups in terms of raising this money, right?
All right, yeah. So essentially, yes, the new tier 1, tier 2 mini IPO options. Although this is going to be more freeing for a lot more companies and it'll let more people get into the game, this is for sure not for companies that are still a bunch of founders sitting around with an idea. This is for companies that are about like a year or two into their operations. They're really already out there. They're doing their thing. They are probably going to be very consumer facing and we'll have customers that are familiar with them. So you're right. This is not for everyone, and just like it's limiting to the companies on the bottom end, it's also limiting the companies on the top end, like Uber or Pinterest, for example. These are two startups that people are familiar with, but these companies are already raising money at such high levels. I mean, Uber's
high valuations.
Yeah, I mean they're already worth. Uber itself is already worth $50 billion. So there's no point in it trying to raise $50 million this way. So this is going to be definitely very niche. It's going to be for a very specific kind of company. But there will be some out there that it makes sense for.
I just hope it matters for more than just, sort of the middle upper tier of sort of startup companies, the ones that really don't need it. But we'll have to see. Salvador, thank you so much for being with us. That's a great explanation. We're going to put up a link to your stories of Salvador Rodriguez is the Silicon Valley correspondent for the International Business Times. Thanks again for being with us. As always, you can send me your real estate investing questions on Twitter and Facebook. And please share this video with everyone on social media. Don't forget to check out my brand new series, The Intentional Investor, How to Be Wildly Successful in Real Estate at the WIT Nation store or at thinklinkstore.com. See you next time. I'm Ilyce Glink.